For the past decade, India earned a reputation as the world's Goldilocks economy, maintaining a steady balance of consistent, manageable growth. Today, that reputation is unraveling as foreign capital rapidly exits the Bombay Stock Exchange. This chart tracks the historical value of the Indian rupee against the US dollar. Notice the sharp, steep decline at the end, plunging past the 96 rupee mark, a severe psychological and economic breaking point. The secondary blow lands directly on the consumer. Wholesale inflation has surged to 8.3%, marking a 42-month high and rapidly driving up the cost of basic goods. When an economy experiences slowing growth at the exact same time prices are surging, it enters a state of stagflation. The traditional engines of wealth creation stall, but the cost of living accelerates. The origin of this crisis bypasses domestic policy in New Delhi. Global geopolitical shocks have collided with a permanent revaluation of physical resources. To understand why wallets are emptying in Mumbai, we have to look past domestic data and map a physical bottleneck 1,500 miles away. The immediate catalyst is the naval blockade in the Strait of Hormuz. Commercial traffic through one of the world's vital transit routes has effectively stopped. Prices are rising globally because the physical transit of existing goods is blocked, creating a supply shock. It is a crisis of logistics, not a surge in consumer demand. India's exposure to this specific bottleneck is severe. The nation imports 90% of its crude oil requirements. Internal data reveals the source of the damage. Domestic fuel and power inflation has soared 24.7%, while food grain inflation has actually dropped by 1%. The inflation is imported. An economy that relies entirely on imported energy remains a hostage to the mechanics of global shipping lanes. The standard method for fighting inflation is managed by central banks like the Federal Reserve, which raise interest rates to cool down economic activity. This diagram illustrates the balance between interest rates and economic growth. But this tool only works on demand-driven inflation. Making money more expensive to borrow doesn't clear a blocked naval strait or extract more oil. Physical reality overrides monetary policy, crushing economic growth. Raising rates in this environment carries a severe secondary risk. It destroys the labor market already showing significant weakness without solving the underlying supply issue. While the US is currently absorbing this shock with a 3.8% inflation rate, India is absorbing the exact same global shock at 8.3%. Relying on monetary institutions to fix physical supply bottlenecks guarantees an extended period of high inflation paired with stagnant growth. That expensive imported oil still requires payment. We must look at the other side of India's balance sheet. This flowchart maps India's foreign exchange mechanisms. On the left, dollars flow out to import oil and electronics. On the right, dollars flow in through exports, driven heavily by major IT services firms. A secondary threat is now putting pressure on the right side of that equation. The industry calls it AI deflation. Automated coding tools are replacing the labor-intensive billing models that Indian tech giants have relied on for decades. Large engineering teams are no longer required for tasks that an algorithm completes in seconds. Back at our flowchart, the AI deflation node shrinks the IT services export flow, widening India's $300 billion trade deficit. The gap between imports and exports widens dramatically. India pays more dollars for physical energy while earning fewer dollars for digital services. The country is bleeding capital from both ends of its trade balance at the exact same time. The oil blockade provides the immediate pain, but global metals dictate the long-term economic signal. We are entering a macroeconomic phase defined by prolonged structural resource scarcity, a commodity supercycle. The last supercycle occurred in the 2000s, driven by massive Chinese urbanization that consumed bulk materials like iron and coal. The 2020 supercycle runs on different mechanics. It requires global electrification, expanding data center infrastructure, and the reshoring of supply chains. This line chart demonstrates the market split. The flat gray lines represent stagnant pricing for traditional bulk commodities. Watch the lines for copper and uranium. They break away completely, shooting upward, pricing in the materials required to build the future economy. Copper serves as a non-negotiable physical bottleneck for expanding power grids and AI data centers. Extraction requires massive physical scale and decades of lead time. Uranium provides secure baseload energy that remains completely independent of volatile Middle Eastern supply chains. Governments are no longer pricing these critical materials based on standard market supply and demand. They are acquiring them as vital sovereign security assets. Nations will print money to secure these physical assets at any cost. Consequently, a higher baseline of inflation is permanently embedded into the global system. The empty wallets in Mumbai and the capital flight from the Bombay Stock Exchange take on a different context through the lens of this supercycle. This stylized global map shows the relationship between consuming nations and resource producing nations. High resource prices act as a mandatory tax, extracting capital from the consumers. As the arrows indicate, that wealth is actively drained from consuming nations and flows directly into the treasuries of producing nations and the portfolios of commodity investors. Many investors operate under the misconception that the market is waiting for prices to return to normal. That previous state of normalcy no longer exists. The brutal friction of transitioning into this resource constrained era is exactly what stagflation feels like in real time. A massive structural global wealth transfer is currently underway. In India, the mechanics of this transfer present as a localized economic crisis. So-called stagflation light is not a temporary glitch. It is the new operating baseline for the global economy. This dashboard displays the three specific indicators professionals must monitor to navigate this era: crude oil, copper, and the dollar to rupee exchange rate. The price of crude oil measures the immediate short term geopolitical pain. The price of copper futures dictates the structural long term cost of building the future economy. The US dollar to rupee exchange rate acts as the ultimate scorecard, measuring India's ability to survive the pressures of both oil and copper. India's economic trajectory over the next decade relies entirely on recognizing this resource scarce regime and forcefully abandoning the outdated strategies that only worked in the cheap energy era of the distant past. Nations are currently engaged in a strategic hoarding of hard assets, prioritizing energy security and industrial resilience over short term costs. This is a flight toward physical resources, a shift toward heavy commodities that define modern infrastructure. The price spikes are staggering. Global copper is up over 41%, while aluminium has surged by 51% compared to this time last year. The global baseline has shifted, with structural supply constraints meeting an urgent policy-driven demand for resources. These rising costs represent the early stages of a new commodity supercycle. To see how different economies process this shock, we have to look at the United States. In the US, the consumer price index has risen to 3.8%. It is a measurable squeeze, but economists are classifying this as stagflation light. The US avoids a full economic breakdown because of a single structural advantage. They are a major global producer of oil and natural gas. This chart shows the defense mechanism. Because domestic energy production nearly matches consumption, it acts as a physical shield against a global price spike. This buffer protects the core of the American economy from the worst of the inflationary fallout. Nations without deep domestic energy reserves do not have this luxury. They are forced to absorb the full unmitigated impact of the global supply shock. Energy independence is the ultimate macroeconomic shield. Those without it remain entirely at the mercy of the commodity cycle. For India, the transition from global market trends to local reality is direct and unforgiving. The nation's economic vulnerability is defined by one foundational data point. India is required to import roughly 90% of its crude oil. And as the second block shows, the country also imports 50% of its natural gas. This dependency is mechanically rigid. Energy demand is inelastic. India cannot simply consume less oil to lower costs, when factories and transportation networks require that fuel to function. Consequently, the nation must instantly pay billions of dollars more to foreign markets just to maintain the status quo. When global prices spike, these import costs expand rapidly, crushing the smaller export blocks and tearing open a massive trade deficit. This is compounded by heavy consumer demand for other imported goods, specifically electronics and gold. The resulting data is stark. The merchandise trade deficit jumped to a staggering $28.4 billion in April alone. Oil remains India's structural Achilles heel. Every global price increase acts as a massive, uncontrollable tax levied on the nation by foreign markets. That massive trade deficit triggers a perfect storm, a mathematical feedback loop that drains value from the domestic economy. The first step is the currency mechanism. Since oil is priced in US dollars, India must sell massive amounts of rupees to acquire the dollars needed for its energy imports. Dumping rupees onto the open market increases the currency's supply, which directly destroys its exchange value. This dashboard tracks the loop. In panel 1, the rupee has plummeted to an all-time low of 96.14 against the dollar. Step 2 is the multiplier. A weak rupee makes every other imported necessity, from fertilizers for farms to microchips for factories, exponentially more expensive. In panel 2, wholesale inflation has surged to an 8.3% high, with fuel inflation specifically hitting a brutal 24.7%. Step 3 completes the circle. Explosive inflation and global uncertainty spook foreign investors, causing them to pull capital out. As panel 3 shows, this flight feeds back to panel 1, forcing the rupee lower and trapping the economy in an endless loop. This mathematical loop transforms a distant energy shock into deeply entrenched, self-sustaining domestic inflation. This import-heavy model creates a different set of rules compared to the export-led economies of East Asia. While those nations can use a weak currency to make their exports more competitive abroad, India's structural reliance on imports denies them that escape hatch. This leaves the Reserve Bank of India trapped in an unwinnable policy bind. The central bank is caught in a macroeconomic vice. If they raise interest rates to save the rupee, they will choke off business lending and kill domestic growth, effectively guaranteeing a stagflation scenario. If they do nothing, imported inflation will run uncontrollably hot, destroying the purchasing power of every Indian consumer. There are no simple adjustments that can fix a structural deficit during a global energy crisis. These stagflation fears reflect a mathematical certainty. An import dependent economy is now bearing the full weight of a fractured global supply chain.